very warm welcome to you all from everyone here at London South East. For those of you who don't know me, I am Donald Leggett. I'm Head of Investor Relations at London South East, and I'm your host for this evening. Once again, we're delighted to welcome Primary Bid, who are sponsoring our autumn webinars. Primary Bid's focus is to give retail investors, just like yourselves, access to one-off public company fundraisings and IPOs on the same terms as institutional investors. The best way to keep up to date with their fundraisings is to register for their website, primarybid.com. The four companies speaking tonight are Greatland Gold, Poolbeg Pharma, Helium One Global, and Rainbow Rare Earths. Collectively, they have already attracted over 1,250 registrants to tonight's event. That's 1,250, guys. That's a lot of you, making it one of the biggest London South East events of 2021. As usual, the CEO gets 30 minutes to make their investment case, with perhaps 20 minutes spent talking to slides, and then we take questions from you, the audience. You can write your questions now by clicking on the Q&A button towards the bottom right of your screen. You need to give us your real name. You need to tell us which CEO the question is for, and keep things short and understandable. And for those shareholders who can't make it tonight, why not summarize events on the London South East company chat board pages? Our bulletin boards are read by everyone from company senior management, brokers, and AIM institutions through to financial PRs. So your views really do make a difference. Finally, let me tell you about our next live events. We have 2 more webinars before Christmas. On Tuesday, the 16th of November, when we have Advanced Energy and Alien Metals speaking. So if you're fans of those, do make a note in your diary. And on Tuesday, the 7th of December, we have its Cora Gold, and as yet unnamed company. There you go, a mystery guest. So do look out for our email alerts on that one. And as an innovation, we're going to allow you to download slides tonight. So if you go to your chat function, you will find the slide packs for each presenter in there. We will release each one as and when the presenter begins to talk. If you download those, you can follow them from there. Okay, that's it for tonight's housekeeping. Do try to make it through to 8 p.m. because we have some excellent companies for you. And here we go, over to Greatland Gold. We start the evening with AIM-listed Greatland Gold, the mining explorer and developer at the development stage of a world-class gold copper discovery in Western Australia. Havieron is a world-class asset, and Greatland chose to JV with Newcrest, Australia's largest gold miner. Newcrest are experts at low-risk development, and their nearby mill at Telfer makes Havieron a low-capex project. As you might expect, Greatland is already exploring for a further Tier 1 mineral deposit in Paterson using advanced exploration techniques. It's working hard to become a multi-commodity mining company of significant scale. It's not doing too badly, as today the market cap is around £700 million. We're delighted to have the CEO, Shaun live with us from Australia. Welcome, Shaun.
Thanks, Donald, and thanks for having me this evening.
It's absolutely fantastic to have you this evening. Thank you very much for staying up so late to be with us.
It is a little bit late here in Australia, but yeah, happy to do so. Good to connect with you and the audience.
And that huge audience that we're bringing to you tonight. So over to you, Shaun.
Okay, swell. Look, we've got 30 minutes, so why don't I spend 15 minutes going through the presentation. An important event last week for Greatland with the release of our pre-feasibility study on the Havieron development, and that will leave us a solid 15 minutes for questions, which I think people will enjoy. So with that, look, let me just start by orientating people around the strategy of Greatland. There's 3 key pillars to our strategy. Firstly, look, expansion of Havieron. We want to deliver Havieron, a world-class asset, on time and on budget for the benefit of Greatland shareholders. In addition, we want to accelerate our commitment to exploration. We want to continue to expand that program. And of course, we want to invest in that drill bit and try to create value for shareholders through discovery. And then finally, the third pillar is that opportunistic growth. How do we augment what we have already in the portfolio by continuing to look to improve that portfolio, perhaps by acquisitions and other opportunities to, add financially disciplined opportunities into the portfolio. The feasibility study itself, or the pre-feasibility study, is an important step for us, but it really is a first step on the journey. We commenced the decline earlier this year. This study is really designed to support that initial infrastructure going into the ground. As people would be aware, this first step is just on the southeast crescent of Havieron. That's this high-grade backbone that sits across this southeast. It's really just a fraction of the Havieron ore body, and indeed this study just covers a fraction of that southeast crescent, even really making it a fraction of a fraction of our ore body. And such is the quality of Havieron that, notwithstanding, there's only a small part of Havieron included in this study, it still delivers significant returns for shareholders, notwithstanding it's carrying all the capex to get Havieron into development. And this slide really just shows that pathway to first production towards the end of calendar 23, and then full-size production into calendar 24. I talked earlier about this study is really just the tip of the iceberg. Even within that growing resource base, this only constitutes 28% of that initial resource. And I talked before about the return that this study still delivers of a 27% IRR and a 3-year payback. That's notwithstanding, to develop the southeast crescent, this small part of the ore body needs to pay all the capex for the haul road back to Telfer, the power coming back, development of that Havieron permanent camp, and the decline all the way down to the ore body, and around 550 meters of development. So it's a substantial amount of capex, and the fact that it still generates this return, this payback, unlocks all that free cash flow for us, again, just speaks to the quality of the project. And again, we've done all of this with our partner Newcrest, which has 35 years experience operating in the Paterson, which gives them a lot of insights on cost structures. They're already operating in the Paterson, 45 kilometres down the road in Telfer. That's a big part of the centre of gravity for the development of Havieron, and all those costs are very understood. So it also makes the reliability of this study, I think, very high. This slide is worth pausing on. We've also released our maiden reserve, and I like this this diagram of Havieron in the centre there, because this helps hopefully portray what I mean by a fraction of the ore body. The broader zonation is this grey breccia, and then we can see this kind of looks into that ore body and cross section from the southeast, highlighting the southeast crescent on this side, which remains open at depth. But just those red areas is what's being stoped, what's being mined out. So you can really see this is just a fraction of that southeast crescent, and gives you some flavour as to the upside, the growth that is ahead of us. The best of Havieron is yet to come. The capex is exceptionally low, and I think that's really positive for us. The way this is being developed, by driving into this high-grade southeast crescent, is just tailor-made for Greatland as a mid-cap. For us and our balance sheet, we want a low capex hurdle, a low funding requirement to jump over, and then get this high-grade ore through the mill, create free cash flow, and then we can generate that to deliver further growth. That's continuing to grow Havieron and continuing to fund our exploration activity. So effectively, by getting Havieron into production with this southeast crescent, Greatland becomes fully self-funding. With this initial $73 million that we need to fund, I think there's a great opportunity for us to engage with banks to bring this in. From a banking perspective, they also see this as low risk. It's brownfields development for Newcrest, leveraging that existing Telfer infrastructure, and that's an exceptionally modest value for a development to get into production. And what, again, talking I think to the quality of Havieron, the discovery of Havieron and the announcement of that Hav5 kind of first discovery drill hole, as we think about it, was in 2019. So it's been an extraordinarily short period of time to be here with the development already underway, the study complete. And again, I think talks to the confidence that we have at Greatland of putting this into production. And perhaps it also gives you a feel as to the approach Newcrest is taking into this and their desire to get Havieron ounces through the mill. And again, this slide really just captures the fact that we are leveraging this existing infrastructure, and that's what makes this low risk threshold to get into production, and makes that profile of capex relatively low. That unlocks us into production. And the takeaway on this slide is really just that grade. 4.58 grams is an exceptional grade. And that really tells you why we're targeting this southeast crescent. It's a high grade ore, so it's going to generate really strong returns. And we'll talk about cost shortly, but that allows us to create a margin of over US $1,000 per ounce, which is exceptional. So turning to that low cost nature of Havieron, this is a cross-section profile of the cost of Australian gold mines. And you can see Havieron to the left of screen as we look at it. It's very much in that lowest quartile. And when you look at those Cadia, Fosterville and Tanami, those assets are all in significant portfolios, are really bellwethers of the Australian gold sector. And that's the company that Havieron keeps. It's an exceptional place to be in. And it tells you that Havieron operates through the cycle, which I think, again, is really important. And perhaps this is my favorite slide in the whole presentation, which again centers on the cost. And it presents that Greatland as a company would have the second lowest all-in sustaining cost on the planet. That's kind of worth pausing on for a moment, that we would be the second lowest cost miner on the planet. Again, it talks to the quality of Havieron, and with that, there's also some potential to walk down these costs from the study. This study does, we are going to continue to look at the study in more detail. And we've already announced that although this is a 2 million tonne per annum study, we're actually going to be taking a 3 million tonne study through to the next stage of feasibility study. And again, there's opportunities to walk down the cost with improved efficiency from that larger scale operation. And the study assumes that this is the only ore going through that Telfer mill. So presently just 2 million tonnes per annum going through a 20 million tonne per annum mill. If we can increase the volume of material out of Havieron, both from that southeast crescent and from the bulk opportunities across the rest of Havieron, we have a great opportunity of amortizing those fixed costs and that general administration cost across more ounces, reducing cost. And similarly, Telfer owns that Telfer ore body. For those following Telfer, or following Newcrest, they certainly are promoting the opportunity that they'll be able to continue the life of Telfer. And again, that will be more ounces, will reduce the cost for Havieron, which is beneficial for us. And again, hopefully brings more material into our economics. And similarly for Telfer, lower costs, provide that virtuous feedback loop that more Telfer ore will also be economic to bring through that mill. So good for both companies, good for both mines. Yeah, this slide just really tries to talk about that expansion opportunity I've just touched on, that this study is just looking at that southeast crescent. The great expanse of that ore body is sitting inside that breccia. And as we continue to drill that, as we continue to understand that part of the ore body better, we get closer to understanding the opportunity to apply a bulk mining methodology across there and absolutely change gears to a much larger Havieron development. This is an important slide. This one, it just talks to that infrastructure that's being put in place with this initial Havieron development. You can see that decline down the left-hand side of that ore body. All of this capex of that initial 400 metre through the Permian layer, and then down that 550, 600 metres across the ore body is all being carried by this existing 14 million tonne study. The potential to bring more ounces on these existing levels for extremely low capex, and then expand it down a little further to bring in the rest of that southeast crescent is still only a fraction of the capex that had to be spent on this initial development. There doesn't need to be a second haul road. There doesn't need to be another camp built. It's really just an extension of the existing infrastructure. And that tells you that the capital efficiency of that larger study is going to improve. And again, we're taking that 3 million tonne study through to the feasibility study. And then, of course, there's the opportunity to augment all of this with that further bulk mining study across the whole size of Havieron. I'm conscious of time, so I'll skip across this slide, but I think let's pause for a moment on this Havieron slide, because this is about that broader zonation. That red area there, that southeast crescent, is effectively that part of the ore body that is captured by this study. But that broader grey outline and indeed the extensions with the blue is that broader zonation. And as we continue to drill, what we're seeing is that northwest crescent, described as that northwest pod target, is starting to join up into that northern breccia to create this corridor of higher grade through the centre of the ore body, together with good intercept sitting outside of that area. But we're definitely seeing this northwest trend, which is a little bit of a feature of the entire Paterson district. Then what's exceptionally exciting and something that we're spending a lot of time on is that eastern breccia target. This is sitting outside of the original Havieron area. It's a really interesting, it's a new intrusive, slightly different geochemical signature. Havieron doesn't need to get bigger to be world-class, but sitting there in the eastern shadow of Havieron, we're seeing another really meaningful feature. When you get 200 metre width intercepts, that's something that really captures our attention. And the overexpansion of that is some 600 and 750 metres. So exceptional to have that growth opportunity already within Havieron. Sustainability, look, I'd love to spend more time on this, but again, in the conscious of time. But again, I think we should have a lot of confidence in Newcrest as our joint venture partner to focus on this area. And they're certainly, from our perspective, it's something we really want to see a lot of focus on as well. I do want to pause on the exploration opportunity. We've talked about Havieron. There's also proximal targets. We've recently significantly expanded our footprint across the Paterson. We want to continue to have drill rigs spinning across our Paterson holdings. And we really like the option value that creates within our portfolio. For us, finding the next Havieron and applying our competitive advantages in looking undercover, in using that expertise, is really important to us. And indeed, there was an announcement today with Jury, which is the other joint venture here on the map, marked for the Black Hills deposit, with Newcrest, that we're moving to stage 2, which means Newcrest is is seeking to put another $17 million into that project to continue exploration, which I think is good news for Greatland shareholders. The broader portfolio, again, we enjoy, particularly Ernst Giles, I've spoken about a few times, is Archean Greenstone, where a lot of Australian discoveries, gold discoveries sit. I think it's great to have that in the portfolio. For those following us, the team, we've spent a lot of time investing in the team. We've built that up. And again, it's all part of us having the ability to understand, to contribute to, with peer review, Newcrest, and scrutinise the development to make sure it's in the interest of Greatland shareholders. And with that, we've also added to the board. I think Paul Hallam's been an exceptional addition to the board, very well known in the Australian environment. So with that, why don't we try to jump across to some questions, but hopefully that gives you a really good overview of the company presently, and particularly this recent pre-feasibility study outcome.
Great, thank you very much indeed for that, Shaun. So the pre-feasibility study, all good. Why did you particularly plan to go down the early starter mine route? What was the thinking behind that? And did it come from Newmont, or did it come from you guys, or was it a classic JV?
Look, the joint venture is, has a, tries to create cooperation between Newcrest and Greatland, and we have a very good relationship with them. But I think the real driver here is that Telfer was coming to the end of its mine life. In 2024 is meant to be the last ore as Telfer is presently contemplated. Of course, I think there's a great opportunity for them to add to that life. But Newcrest doesn't want a gap here. They don't want to demobilise Telfer and then recycle it up as Havieron comes online. So there's been this big driver to get Havieron ore into Telfer by 2023. Part of the great benefit to us is not just the physical infrastructure there at Telfer, but the 1,200 people in situ with that 35 years collective experience up there in the Paterson district. So I think it's in both companies' advantage if we don't have a gap here at Telfer, and we plough into Havieron quick snap, and that's what this study helps supports.
Does that add weight to the 3 million tonne study being a possibility then that you were mentioning? Yeah,
look, this study is based, that's been released, is on a 2 million tonne study. To some extent, it's already out of date as it's been released, because we're taking something 50% bigger, being a 3 million tonne study, into the next round, the feasibility study, which is due out around this time next year. And then, of course, augmenting that, we're looking at a much broader mining program with the bulk mine. So really, this is the best of Havieron is ahead of it. And I did hear Sandeep from Newcrest describe the other day in the Newcrest call, the economics only get better from here. That's exceptional to have a study that's so strong already and really just see upside ahead of it.
Perhaps we ought to talk jury stage 2, and 17 million or more of Newmont money going there. You guys are serious about this, aren't you? You're really, really going fast and hard.
Yeah, look, absolutely. Look, I think it's, we see our presence in the Paterson as multi-layered. We've got the Havieron, obviously, the jewel in the crown and the flagship asset, and that takes a lot of the focus. Then we have further exploration with Newcrest, and we like working with that team. They've got a lot of experience, and we learn from each other through that, and we've got a huge amount of respect for them. And we're delighted that they're taking jury through to the next round. And again, it reflects some confidence that we have in the ground there. We hit some first mineralization there recently. It's always nice to know that the rocks there are carrying some level of mineralization. And then thirdly, we have 100% owned ground. I'm particularly fond with that. And as some shareholders would appreciate, we currently have the rig spinning at Scallywag, our 100% owned tenement, as we speak. So, we're excited about that program into which is going to move forward to the end of this calendar year.
Okay. Jonathan Dixon asks, I think you asked several questions, but one of them was about your funding options for the $73 million that you mentioned. That's your share of the joint venture due. How do you propose to raise that? Bank, or is it debt or equity essentially?
Yeah, look, it's a great question, I think, by Jonathan. The overall funding, if I take a bit more of a moment to explain it, is about 123 million US. Now, 50 of that is being provided by the existing debt facility, which is drawn for about 20 million, and we have 30 million remaining. That gives us a lot of runway. That's meant to take us to around this time next year, to about September, October 2022. So there's no particular urgency in further funding. So time is always valuable in these circumstances. But what we'd like to do is engage with the banks. We've already had two or a couple of term sheets given through to us by major banks. We want to continue to engage with them. Really, the banks are lined up around the block to fund something like this. Brownfield, Newcrest quality, tier 1 asset in Australia, which is a tier 1 jurisdiction. It's right down the fairway for the banks. So what we'd really like to do is bring them in, complete a full funding package, and that perhaps covers that entire 73 million. And again, we've got the time frame to do it. And such as the quality of this pre-feasibility study, not just the outcome, but the amount of work that's gone into it, and the ability to leverage the existing infrastructure and the existing known cost structure, gives the banks a lot of confidence around the quality of this study, which gives us every opportunity to actually bank a pre-feasibility study, whilst normally you'd have to wait for the final feasibility study. I think we have every opportunity to bank that ahead of schedule. So something to look forward to in the next, say, 6 months. So
listen, folks, that's what you've just said is very significant, isn't it?
Yeah, look, I think it's exceptional to have a discovery in 2019 and in 2021, having already started the decline down, and then having such a low threshold of CapEx that is into production, and then we're generating that free cash flow that we can reinvest into Havieron. Again, tailor-made for the balance sheet of a junior or a global mid-cap. And we should really be popping champagne corks that, that with our partner, we are charging into this development, rather than sitting back and maybe unlocking the whole Havieron, which we're all terribly interested in seeing. But of course, that would, if we sat back and studied this to death and drilled it out like a bin cushion, it would add time and cost before we got to that free cash flow event. So I think for us, it's perfect.
So before we lose you, Newcrest Mining can apply to buy a further 5% of the project in December. This is another one from Jonathan Dixon, mentioned by a few others. How on earth can you get an accurate fair market value worked out when there's still so much infill drilling and developing of the asset remaining?
Yeah, another good question. Look, it's interesting. I've come in kind of post that original deal being done with Newcrest, and naturally you see the strengths and the weaknesses of transactions when you come in. It's interesting looking at the option being exercisable in the current period, because Havieron's still in this growth phase. The good news is, I think in this is, it's something that's got to be worked together between the two parties. The pre-feasibility study, as we've said, only covers really a fraction of this ore body. So when you're trying to understand the market value of the asset today, look, you have a great citer there with the pre-feasibility study in terms of low CapEx and low cost. But what do we really want to add to that study? We want to add a lot more tons, a lot more ounces. And that exploration program does show you that, look, there's a lot of opportunity there on the southeast crescent, and then the broader, bulk mining opportunity. So the opportunity is to try to add value across those areas as well when thinking about what is the full value of Havieron, and as such, what's 5% worth. But there's no doubt over time that becomes more and more apparent and lower risk to achieve. So with ongoing drilling success. So I think the more drilling that gets done, the better positioned we are in respect of that option.
Okay, a very brief last answer. I'm sorry to rush you. This is absolutely fascinating. What do you expect to see in the next 6 to 8 months? What can we look forward to?
Yeah, look, I think it's a really busy period. Yeah, some 50,000 meters of drilling have been completed since the cutoff of this pre-feasibility study that we already have. A lot of that's been announced. We have in the next couple of weeks, we have an updated exploration announcement. We're looking to update JORC resource and reserve statement in the coming months. That's really significant. We talked about the funding program going on, and then that all leads into the updated feasibility study. So there's a huge number of catalysts and a lot of work happening over the next kind of 6 to 12 months. And I think that creates a great opportunity for Greatland and its shareholders.
Shaun Day, CEO at Greatland Gold, thank you very much indeed for joining us live from Australia this evening. Thank you. You're such a star.
Hey, Donald, really enjoy the time and the discussion. So thanks again.
I'm sure our audience did as well. Thank you so much for sparing the time. Thank you.
Okay, take care, everyone. Thank you. Bye.
And our next company up is Poolbeg Pharma, who, as you probably know, are the AIM-listed pharma business which was spun out from its famous parents, Open Orphan. They spun out in July and they raised £25 million. Poolbeg is targeting the infectious diseases market, which is expected to exceed $250 billion by 2025. POLB's initial assets come from Open Orphan, the infectious disease and human challenge trials business. That's the one that you know all about, which means Poolbeg has access to knowledge, experience, and clinical data from 20 years of clinical challenge trials. The company has already inherited a phase 2 ready influenza immune modulator and says it hopes to acquire new assets. Here with us tonight to shed more light on the business are Jeremy Skillington, CEO, and Cathal Friel, Chairman.
Good evening, Donald. How are you?
Good evening, Jeremy. And Cathal, you hearing us, Cathal?
Loud and clear. Can you hear me okay, Donald?
Oh, absolutely perfect. Brilliant. Okay, so I'm going to leave it to you to do your presentation. Over to you guys.
Sure. The usual disclaimers, and I'll let Cathal give a little bit of background to where we came from, and I'll talk at length about where we're going.
Yeah. So look, folks, delighted to be speaking here from Whitechapel in East London. It's dark outside in the offices. This is the Open Orphan Poolbeg office. So look, the background, look, I'm very excited. We've had a good run with Open Orphan. We've got a lot more running to do there. As they always say, what's that space between now and Christmas? We won't disappoint you, the long-suffering shareholders. But tonight's about Poolbeg. Where did it come from? We're trying to build a leading infectious disease company. Poolbeg Pharma successfully spun out of Open Orphan in July 21, raising 25 million, a heavily oversubscribed fundraise. And basically, look, the background is Havieron is a clinical trials company. Clinical trials company should not be competing with our customers. Pfizer, the CEO of Pfizer announced earlier this summer that we did a cracking phase 2 RSV study for them. That was in Open Orphan Havieron. And naturally, the CEO of Pfizer doesn't mention many small companies like us. I'm sure he'd be quite pissed off if we turned around and said, by the way, Mr. Pfizer, we have a better product than yours. But we might have. And that's where Poolbeg comes in. So the assets are in Poolbeg, and Jeremy's job is really to drive Poolbeg. But I think, look, there's probably a bit of confusion. And the reason I'm so excited, it's always great to have something unique. Poolbeg is absolutely unique. Bear in mind, my first pharma company now, Amrit Pharma, Donald used to present maybe 8 years ago, was formerly known as Facet Oil and Gas, a little 20 million struggling company. Amrit now is $1 billion enterprise value, did 200 million last year, 300 million this year. So look, we've big plans, and Poolbeg, I think, will go up many, many multiples in the months, not years ahead. But why is it unique? It's unique in that we're not falling in love. There's going to be a host of assets. Jeremy's under pressure, and he will get them in. Over the next couple of months, we'll be between 6 and 8 additional assets like POLB 001. We're not going to pay very much for them. We're going to get them cheap up front. And Jeremy will tell you how we're going to do that. We're not going to spend too much, but critically important, we're fully funded. This is not a little pharma company that's going to be raising money and raising money. We're fully funded. And we're going to spend 2-3 million per asset. And then Jeremy's got a huge knowledge and background on the business development side. So every week, every month, we'll be talking to big pharma. So if any one of these assets work, it's many hundreds of millions. And just look why I say it's unique. Jeremy's last company, Inflammasome, was $500 million upfront and potentially $1 billion. That's almost 60x return on shareholders' value. The only other company in the whole of Europe is doing something like we're doing is Evotec in Germany. It changed focus. It was a CRO 4 or 5 years ago, 300 or 400 million market cap, sharp price 3 or 4p. Just look at Ergomed today. Not Ergomed, Evotec today. Sharp price is 43, 44, 10x uplift, 7.5 billion. So that's no pressure to Jeremy. I will be hanging around more often, but that's the kind of uplift, 10x. So without further ado, Jeremy can tell us how we're going to do that 10x. But I'm actually thinking this is probably one of the most exciting opportunities outside of open orphan. Over to you, Jeremy. Thank you.
Thank you, Cathal. Appreciate the colourful introduction. Yes, I'm very excited to be on board, and I appreciate the audience here tonight for joining us, which for a presentation is quite different than the last one, but congratulations to them. So as Cathal said, we inherited assets from Open Orphan when we spun out. We're, as I say, relatively new. We're just 3 months out. And we've started going with what we've inherited is down here on the bottom, POLB 001. This is an immunomodulator for severe influenza, and we've got plans in place to move this rapidly into the clinic. There'll be a recurrent theme through this presentation about speed and being cost effective, and I'll speak about those. So I'll talk about that later on. On the left-hand side, what I'm very excited about is, as Cathal said, we've got a very unique data set where we're going to interrogate all of this by artificial intelligence, and that technology is, as you know, relatively new. As computer power has increased, we're now in a position to be able to mine this challenge data, this infectious challenge data, to see how the immune system is responding to an infection, and then coming up with new targets and new drugs to target those. So we'll be very unique in this. This is something that Pharma isn't even doing because our data set is so unique, and I'll speak a bit about that. And from the other things we inherited, Predict Viral, I have one slide on that. This is we filed new IP on this last week around diagnosing pre-symptoms, who's going to get a severe infection, who isn't. And again, fascinating. The biology of this is just absolutely fascinating. You could do a full presentation on this alone, but obviously not tonight. And then I won't touch upon our vaccine discovery platform, but from an infectious disease standpoint, there's 3 legs to the stool. There's therapeutics, there's vaccines and diagnostics, and we're playing in all 3 of those. But as Cathal said, we're very interested in bringing in other complementary programs as well to run them through our very efficient programs and get key clinical data, which is what Pharma wants. And I'll talk a little bit about that later on. I won't dwell on this. The team is absolutely outstanding. We've built a team with great experience, great knowledge, great success, and I think I won't dwell on this too much. We've complemented with again a terrific board across a business experience across the industry, many decades, and including Luke O'Neill, who's a thought leader in immunology. And Luke has been a fantastic asset since he joined the company back as when we were founding back in the early summer, and he brings a lot of wealth of knowledge and experience. Me in particular, I will spend a minute. I'm a PhD scientist by training. I'm almost 19 years now in the industry, starting off in the UK, in the US, in California, working for a company called Genentech, and then moving back to Europe 2009, working for companies in the UK, Germany, and Ireland. So great experience. I've got the Rolodex, let's use the old terminology, of all the pharma contacts, all the pharma BD. And we know that pharma are always looking for products. If you look at their pipeline, roughly half of their pipeline is in license, brought in from other companies. So we will leverage that knowledge, leverage that connections, and be the deal maker of choice for pharma who want to do deals in the infectious disease space. And given what's gone on in the last 20 months, there'll be a lot of activity. And this is summarized here. I think 2015, there were warning signs that we should be aware of a global pandemic, and people ignored it. We know now, 20 months later, what the impact on human health and global economy has been. And there's a demand on pharma and a demand on the industry and governments that this will not happen again. So everybody's gearing up to the next preparedness for the next pandemic. And that's where Poolbeg will be. The market is expected to be 250 billion by 2025. Again, as I say, that's across therapeutics, vaccines, and diagnostics where we're playing. And we plan to be the partner of choice for pharma to give them the assets that they're looking for to fill their pipelines. And I say we'll do the early de-risking at a very low cost, and then pharma will take that on board and bring it forward into a more robust phase 2, phase 3 clinical trials to get the data they need for approval and marketing. That we leave that to pharma. That's their expertise. And this is a slide about how we are different. There's many biotechs out there who bring in money, they spend it all on one program, and if it works, great. If it doesn't, that's it, they're done. And a lot of time you get gray area, ambiguous data. So we don't plan to take that at all. We won't be spending on full phase 2 clinical trials and spending our hard-earned investments. So what we plan to do is take this multiple shots on goal approach, and we'll be capital light. So it's a case about bringing in clinical or near clinical programs, spending 2 to 3 million each program, and using these human viral challenge studies that hVIVO have brought on board and are experts in. And we'll get results in 12 to 18 months. This is human data, and this is what pharma seek, what they crave, what they're passionate about. They can't make big decisions without human data. You can have all the preclinical data you want, but once you have human data, that's what gets pharma excited. So we'll be there ready to have discussions as we're going through the development path, and having multiple discussions with pharma and creating a bit of a bidding war. And as Cathal said, you do one deal and it's for eye-watering amounts, and I'll talk about that later on. So the plan is to bring in multiple programs, as well as pushing on our internal programs, as well as sourcing our finding from our internal programs, new targets, new drugs, and then develop them rapidly. So we've got a clear growth and partnering strategy. As I say, we won't plan to bring this forward ourselves. We're not going to be a fully integrated biotech company. We'll do the early de-risking and be very clever with the spend. As I say, monetize 5 or 6 assets, frequent partnering. As we know, any one of these deals could bring in 700 million, and we'll be cash generating from this income from these deal terms. And I just have a few examples over the last few years. And I think it's worth pointing out that infectious disease deals were relatively few and far between before the pandemic hit. And now that's accelerating because pharma, they turn on a sixpence and they realize that there actually is money in infectious diseases, given the Pfizer, BioNTech, and Moderna experiences in the COVID vaccines. So now they're looking at the other viruses, other infectious diseases, where they should put their money, where they put their bets. So a couple of examples here. This is a territorial deal, Reviral license Liam by 120 million upfront for RSV, the space that we work in. Merck acquired Oncommune, who had a COVID program, 425 million upfront to take the company out. And then Pfizer at a relatively niche infectious disease area, Lyme disease, 130 million upfront. So if you get that human proof of concept, human data, this is where Pfizer gets very interested, and we plan to play in that space. Cathal mentioned Inflazome, the last company I worked with, founded in 2016. We raised 55 million from venture capital financing, so private equity, and we exited last year, acquired by Roche, for 380 million euros upfront and significant downstream milestones. And I think what's key, what's worth pointing out, is that we had phase 1 safety data. That's where you put it in healthy volunteers, and we had our molecules in 1 patient. And it showed efficacy in 1 patient, and that was enough to Roche to come on board and swoop us and take us out. And they're moving that forward now themselves in multiple disease areas. And I say it's a good exit for our investors. And of course, from a financing standpoint, this was just announced last month, where the White House has been very proactive to invest up to $65 billion in preparing for future pandemics. And we've already been in touch with the folks at DARPA about looking at our lead program and potentially funding that. So there's a lot of, as I say, a lot of appetite for funding these programs, particularly from governments, and for reasons I gave earlier about not having a next pandemic to deal with. What's interesting right now is we're starting our lead program in influenza. And as I say, we're all sick and tired of viruses, I can only imagine. And a new word I heard last month was this twindemic, which had me rolling my eyes. But I think it's valid concerns that we're still in the presence of COVID. As you know, the numbers are still quite high, particularly in the UK and elsewhere. But what people are afraid of is what's coming from an influenza standpoint. I mean, influenza has been quiet for the last 20 months because people have been socially distancing. They've been mask wearing and washing their hands. But the concern is now, as the world returns to relative normality, that influenza will come roaring back, and that's a grave concern. And this is a slide that we pulled out last month, presented by the World Health Organization. And you can see down on the bottom right here, this is the incidence of influenza in India. So you can see it's been very flat over the last number of years, and now influenza virus is coming back. I actually just got my own flu vaccine today, just in preparation. But there's the concern of to the healthcare system, that influenza comes roaring back, and the COVID pandemic is still here. They're going to be overwhelmed. So grave concerns about viruses and their potential to again cause even more havoc than what they've been doing. So a couple of slides on our lead program. It's for severe influenza. And it's a program that targets a protein called MAP kinase, and I'll talk a little bit about that, P38 MAP kinase. But in an average year, influenza affects 1 in 8 people. 5 to 10 million of these are hospitalized, 12% of these are life-threatening, and there's 500,000 deaths. And I think in years gone by, that was people relatively accepted that these things happen. But I think post-pandemic, post-COVID, there'll be demands to get this number down. And Poolbeg can certainly help in that space. I said there are vaccines out there, I mentioned, but there's a scramble every year to identify the strain of influenza that's emerging and rapidly generating these vaccines in eggs. And it's a long time, it's a bit of guesswork, and the efficacy isn't that great. We're used to better. And I think from a flu standpoint, there's a narrow window for therapeutics. Tamiflu is one example where on its label, you can only give this drug within 48 hours of symptoms, and after that it's useless. It's a viral replication inhibitor. So basically, if you already have symptoms, 48 hours after symptoms, there's too much virus on board for this antiviral to have an effect. And this market was once over $1 billion. And as I say, hospitalization that follows from that, there's nothing there for you. And that's where POLB 001 comes in. Because what drives the severe flu is a cytokine storm. And what triggers the cytokine storm is the activation of P38. And we've got a small molecule inhibitor of P38 that blocks that progression. So we block that progression of severe flu and reduce the death rate accordingly. So we've got plans coming next year to get this into the clinic. And I'll talk a little bit about these plans later on, but potential to be a blockbuster for a severe influenza. But of course, in other diseases. I mean, it's well known that these cytokine storms occur in other diseases, other viral diseases, so there's a potential to go broader, so this market could expand for us. And this is our program, POLB 001. It's, the market now is expected to be 800 million, if not greater. Peak sales from the analysts are 275 million for our product alone, but again, label expansions to other diseases. It's a phase 2 ready small molecule, P38 inhibitor. It's already been in the clinic for rheumatoid arthritis. It didn't work. So now we're repositioning this based on data that the team at hVIVO have generated, that P38 has a significant role to play in severe influenza. The molecule is ours. We got worldwide rights, and we're moving that forward. It's safe and well tolerated. As I say, it's already been in the clinic. We've got ex vivo outside of the body efficacy for influenza, and we filed lots of intellectual property. We're protected out to 2038. It was granted in Europe towards the end of last year, and more recently we got very positive response from the US PTO that this will be granted in the very near future with a few minor corrections to the application. So very excited about that potential, because this helps us. This will block anybody else from moving into the severe influenza space with P38. So we've got market exclusivity in that regard. So we've got a clear development plan. We've got a chief medical officer on contract, and we've got plans to put it into humans next year. We've got manufacturing in place, and that's moving along, formulation in place, all of these boxes that need to be checked from a drug development standpoint. So very excited about this, getting data from this, towards the middle end of next year. So that's going to be very exciting. And again, as I say, potential to expand beyond severe influenza into other viral diseases. So that's the lead program, POLB 001, moving along nicely. What's coming behind, I think, is from a data analysis standpoint, I think it's been said that data is the new mining, where the new gold. We're going after lots of data that we have that hVIVO have generated using artificial intelligence, and we've got a number of deals on the table that we're working through. And why is this different? And I think this is a very important slide about how we're different. A lot of time for pharma, there's patients will come into the doc's office, will come into hospital already sick, and they take blood samples and they work their way back from that, trying to figure out what's going on, why are they sick, what's driving the disease. So we've got a different approach, again, coming from the stable of Open Orphan and hVIVO, where we're bringing in healthy volunteers. These are people who are, they're screened, they're identified as healthy. We bring them into the quarantine unit. We take their blood at day -1, so we know what they look like when they're healthy. And then from that, we give them virus, and we track the progress, we track the course of disease, and we're taking sampling all the way along. And these are blood samples, these are nasal samples, these are looking at digital biomarkers, their heart rate, their temperature, etc. And we're able to track all of this data forward, and we can understand what happens in a severe disease setting, what happens in moderate disease, what happens in mild disease. And when we collaborate with the AI companies, they'll take all of this data set and they'll be able to work their way back to identify what are the targets that are being active, what are the targets that the virus is triggering, that the immune system is using. And then when we block those, we have new targets for new effective therapies. So very exciting in this space. This is, as I say, unique. This is unique to Poolbeg. And we already have data in flu, HRV, and RSV, and COVID data, malaria data coming. So we can go beyond the standard viruses and build from there. And this is just a quick snapshot of what we have. We have a facility where we have 300,000 individual samples stored at -80 degrees in 22 freezers. So this is all data that's sitting there, but now we have the wherewithal, now we have the capabilities to use and analyze this data, identifying new targets and new drug compounds that we can put through the clinic. We announced just last week, we've started on our pathway. We have a deal with Eurofins, who are going to do a lot of the gene expression analysis of these samples. And we also have other samples coming behind it that we're working towards. And as I say, we're going to focus initially on RSV, and we're going to focus on influenza, to see where this takes us. And I think this bottom of the slide summarizes what we're going to do. We're going to analyze these samples to uncover common protective pathways, what the body normally uses and what the virus circumvents. We're going to identify what these pathways are and what's useful in the clinic, and then new drugs and drug targets that can be repositioned. Ideally, they've been in the clinic and they've been proven to be safe and effective, and then we can take these forward and do our clinical studies, again, for relatively modest costs. And that's how we're going to, again, how we are different and how we're going to circumvent that expensive clinical trials that people tend to head down. I do want to spend a minute on Predict Viral. Again, we filed intellectual property on this approach last week. Again, this is on the diagnostic side, as I say, that's another feather in our cap of infectious disease, and a very exciting technology where we can identify through gene expression analysis very early in the disease cycle who is going to progress to severe disease and who isn't. So you can appreciate the value of this, in a community setting. If somebody comes down sick and you screen everybody else, you can identify the patients that have caught the virus and move them to the side, and then you look after them and give them aggressive antiviral therapies, separate them from the crowd, as it were, so that the spread doesn't carry on. So as I say, we filed patents on that on a very interesting platform that we plan to progress in collaboration with big pharma, big diagnostics companies, because again, leveraging their knowledge and expertise in this space. So again, a very exciting technology that only we have, and we're very excited about that and moving that forward. So that's, as I said, 3 aspects of what we have already. I will comment that we have multiple discussions ongoing about in-licensing programs. I think pre-pandemic, there was a lot of infectious disease programs that were pushed forward, maybe ignored, not invested heavily enough. But now is the time to bring them into Poolbeg and run it through our system, our capital light, clinically efficient system to get human clinical data and partner with pharma. So my last slide here as a summary, this is a substantial market right now that's growing very rapidly, 250 billion by 2025. The capital light and multiple shots on goal will, as I say, de-risks each individual program, but any one deal will see us generate significant revenue from pharma partnering. And as I say, the lead program, very exciting, is the POLB 001 for severe influenza, a large unmet need. And as we saw, with the data coming out of India, there is concerns that in years to come that these influenza pandemics will rage, and we need better drugs and new drugs for these, and we plan to participate. And again, it's great to have all the excellent science and all this excellent data, but it can't be executed without an outstanding team, and that's what we have. Lots of experience across the board. As I say, we've done this before, we've been successful before, we plan to be successful again with Poolbeg Pharma. So on that as my last slide, I'll stop, and again, happy to take any questions from the audience or from Donald indeed.
Jeremy, thank you so much. Cathal, thank you so much indeed. You packed so much in there. Let's just keep the flow going and talk to you about POLB 001, the influenza immune modulator. Talk us through the next steps. 6 to 9 months in that particular area. What are the next things to happen? What are the timeframes, and how much is it going to cost, and how are you going to fund it?
Sure, Donald. No, sure. I mean, we will fund it obviously by the IPO proceeds, but where we are right now is, as I say, it's a ready-made baby in a sense that we have just completed a campaign around non-GMP manufacturing that we'll use for formulations. These are all multiple steps when it comes to drug development, where we've selected a vendor for GMP manufacturing that we'll announce very soon. And again, different levels of quality. We're working closely with a formulations company to get the formulations going. We're going to have this. I mean, if you can imagine somebody with severe flu being kind of prone and prostrate in the hospital. So we're deciding we're going to take the IV route here, so intravenous drug administration. So we're working on a formulation for that, which is good. So we'll be in humans by the middle of next year to test this proof of concept, in an inflammatory setting. So we're going to get humans and give them, inflame them, and then we'll watch the POLB 001 work its magic, and then take it forward very rapidly there into patients thereafter. And once we have that, I mean, initially having that anti-inflammatory data might be enough to partner with pharma, but they may come back and say we want to see the influenza data, and we've got plans in place for that. So that's all, as I say, very efficient, very capital light. So we will have very interesting data on the inflammation aspects towards the second half of next year, obviously when this initial human challenge trial runs.
Okay, we've got the super cold just about hit us this winter, and we're just about to, as you say, you've had your flu jab. To what extent are these heading in the right direction, as it were, for Poolbeg?
Yeah, I mean, if I understand, I mean, the market, I mean, as I say, pharma is funny. They're sometimes like lemmings, like they turn and, their head turns, whatever's next, and they all rush in one direction. And I think right now they're all rushing in the infectious disease direction. and as pharma knows, like they have army of scientists and chemists working in the background. But, pick any pharma, J&J, Pfizer, Merck. If you look at their pipelines, they in-license so many, like up to half, maybe sometimes more of their programs are in-licensed from small biotechs or mid-sized biotechs.
Well, they need you to find
exactly. They look to the experts, and then they pay big money to bring it in. And again, inflazoma is a great example where we were the experts in NLRP3 was our target. Again, we were in inflammation, which is similar to Poolbeg, so I bring a lot of knowledge across. But they were watching and waiting, and as soon as they saw clinical data, they pulled the trigger. It's time to acquire this company. And Roche were the winners, but there were several other pharma companies in the running, but Roche won out in the end, and really good company to work with. But they're always scrambling. I've got, as I mentioned earlier on, showing my age, the Rolodexes. You have all Rolodex of the BD teams, and part of the scouts is to look for new programs, look for new technologies, look for new partnerships. And I say infectious disease is front and center for a lot of these pharmas right now. So they'll be looking to companies like ours, and when we have clinical data, that's when the scramble begins, and they'll be wanting to come on board and partner with Poolbeg. And as you saw, some of the eye-watering numbers for some of the deals. I mean, from as I say, our IPO was just 3 months ago, but we'll be revenue generating very rapidly. On our first deal, we'll be self-sufficient, and we don't plan to raise any money thereafter.
So you mentioned there the 25 million you raised in July.
Yep.
Do you have any news for us on acquisitions, licensing agreements? Presumably what you have in mind is a buy and build type thing as you build out Poolbeg.
Correct. Yeah, correct. We're multiple due diligence, and I say this with a smile on my face because we're building out the team, but we have a fantastic team of guys, and girls who, they've so much knowledge in the space. We're doing these due diligence on these interesting assets. Some of them are viral, some of them are inflammation. So obviously we're not ready to announce yet. We want to make sure that the I's are dotted and the T's are crossed in these deals and these collaborations. But there'll be announcements coming without question. And I say we build.
What field might the first announcement be likely to be in?
I think safe to say virology, because that's our expertise right now. So we have a lot of spaces, a lot of opportunities in that. And again, what's interesting is as the word of Poolbeg got out, and again, I give Cathal a lot of credit with his network. People turn to us and says, "I've had this asset. We brought it as far as we could, and now we want somebody else to bring it into the clinic." And we're sitting there, kind of lapping these up in a certain sense. But obviously, we have to agree on the correct terms and the correct development plan. All these take a little bit of time. But we've got a fantastic team behind us here at Poolbeg that we're working with to select the best opportunities, and then we move them forward rapidly.
Okay, talking about that fantastic team, we've got that great man Cathal sitting there doing nothing. So let's pull him in.
Never does nothing. Never does nothing.
I know he's sitting there doing some work. I'm sure he is. So let's pull Cathal in, and we'll ask him a 2 or 3 questions. Why not? Okay. So let's talk about Open Orphan. How does the ongoing commercial relationship between Open Orphan, the parent, and Poolbeg, how's that going to work? How you've got access to each other's data and so on and so forth. But give us some nuts and bolts as to how that might work commercially. Who's gaining? I'm sure you're both gaining symbiotically. How is it going to work?
Yeah, Donald, I think, look, first of all, I'm still in the office in London in Poolbeg, or with the office is Poolbeg and we say Open Orphan on the walls, both in the office in London. So first of all, look, it's shared. The big reality is you've been around long enough, I've been around long. Most people listening tonight invest in a range of small AIM-listed companies, and it's just they all build out this big management team and they pay them a fortune. And so we're trying to do with Poolbeg. The only full-time employee is Jeremy. I'm helping out, Ian's helping out, and then we have a bunch of the scientific team, 50% in Poolbeg, 50% open orphan. So that's unbelievable synergies, and that Germany has access to 250 scientists, and then he pays for 2 or 3 of them. So that's the synergies across there. I think, look, to really understand where the company's going to go is look at a peer. We always look direction, you look at the company, and I keep saying the peer is Evotech in Germany, and we're fast followers. Elena Sullivan came in, she's an open orphan director, and she's Cathal, look, she's Scottish with an Irish accent. She's Cathal, look, you really should look at, they've come with the roots from 0. The minute they left their 0 roots, they've had a 10x uplift, went from 400 million to 7 billion in 4 years. So that's, to answer your question, Donald, I think I know a lot of investors saying, well, why bother on a Poolbeg? What I would say, anybody who came into the IPO open orphan, we IPO'd at 5p, 5.7p, we went to 48p. Okay, it's back down a bit now, but I would say bear with us. We're still up 4x from the IPO. Germany's only starting, and we have, look, my role will be to keep news flow, get things in. So we've settled in. The first bit of news flow this past week, I think we've a clear mandate in the company. I told Jeremy we need an RNS every second week, if not every week. So I think all I'd say for anybody listening and watching tonight, Poolbeg is going to get busy. We have to have more assets. There's a lot of negotiation underway. We will have those 6 or 8 assets. Any one of them will be the inflammasome, the $500 million up front. And it's unique. So I think it's the combination of the two of them. You do need the roots and the CRO to know how to do it. You need to know how to get the shortcuts, and you need to have all the multiple irons in the fire, and then it's the synergies in the same office. Chinese walls, no doubt, between us. But yeah, that's cool.
Okay.
That was the question, Donald.
That's a good answer. What kind of milestones can we expect over the next 6 to 8 months then? When, we're looking out ahead, but not too far ahead, 6 to 8 months. What's going to be happening?
Well, I'd say maybe, and again, my role now, I'm reasonably busy. I'm sure people know tonight with one of the 2 full-time jobs open up. But like we've said to Jeremy, is that the milestones is by Christmas. We need at least 1 or 2 more products on top of POLB 001. That should happen. We need 2 or 3 more by the springtime. I have a goal. We need 6 of these damn things. And I say these damn because it's a lottery. You get your number, you got to work them. And then I think Jeremy, look, is clear. AI, we've got access. And look, bear in mind, open orphan retain the data. People are worried, oh, where the data travel? It's still sitting in our reservoirs, but Poolbeg is access to this, using it. So I think AI, Jeremy, what else? A couple of AI deals, a few more deals, and who knows, by springtime, maybe an out-license, a revenue deal, some revenue coming back into us.
I mean, over
to you, Jeremy.
I should say, like the AI deal is the starting point, which is great to mine the data. But what comes out the other end, and these are very efficient, could be 3, 4, 5 months where you get these new exciting targets to be beginning to work on. And I've been involved in deals in the past with Genentech where we're doing deals just on targets. So as Cathal said, you could just identify a new therapeutic target for an infectious disease, a viral infectious disease, and you can partner with that with pharma. But we've got multiple opportunities here from a revenue generation standpoint for building the company, obviously, and as I said, pushing it forward and creating shareholder value.
Okay, last question. Where will Poolbeg Pharma be in 2 years' time? What will it look like in 2 years' time? Briefly.
$1 billion market cap. No pressure.
Say that again.
$1 billion market cap. No pressure, Jeremy.
And what's your take on that, Jeremy?
Billy, I really like Cathal's optimism, but yeah, we're going to be building like a multi-tiered pipeline. I think that's the key thing here. We're going to build a team. We're going to have multiple products pushing through the clinical and partnering. We're going to be a partner of choice for pharma. So we're going to be deal after deal. As I say, I spent almost 20 years in the industry doing deals, with a scientific background. That's the fun part. But as I say, let pharma take it and take on the risk and the cost and push it forward, get it on the market. That's their expertise.
Okay, Jeremy, Cathal, senior management team at Poolbeg Pharma, thank you so much for joining us this evening on what is a very special night for us. We've got huge audience on board, and it's fantastic to have you gentlemen talking. Thank you so much indeed.
Thank you, Jonathan.
Thank you very much.
Thank you. Take care, everyone.
Okay, talking of fantastic gentlemen, the next man to present is David Minchin, CEO at Helium One Global. They IPO'd in AIM last year, and David has never been busier in his life, I suspect. It's all happening. Helium One Global are a very well followed stock now in London Southeast. If you go on the chat board, you'll see multiple posts every day for Helium One. The company are exploring for helium in Tanzania and have already had a drilling campaign in the Rukwa Basin, which has significantly de-risked the basin, according to the company, according to David. Joining us to discuss this and much more, no doubt, is the CEO himself, the man we're talking about, the man of the moment, David Minchin.
Hi, Donald. Thank you very much for the introduction.
Yeah, colourful introduction for you there, David.
I'm Helium One CEO David Minchin, as Donald said, and I'm here to talk to you today about what remains the most exciting helium project on the public market. We've got a basin of 4,500 square kilometres with surface seeps at up to 10.5% helium. We've had a tumultuous 8 months, as Donald might have said, with you can see on the share chart, we were up significantly pre-drilling. We had a phase 1 exploration campaign which delivered everything that we wanted, except for gas flow. Since then, the share price has dropped to pre-drill levels, but that's despite the significant de-risking which has occurred in this basin. What do I mean by de-risking? For the first time ever, we've got proof of a excellent to good quality reservoir units. We've got quality sealing units, especially at the top crew level. We've got multiple prospective intervals from basement all the way up to near surface. And all of that leads towards a high level of charge within a working helium system. We know this is a system that generates and stores helium in the subsurface. The next step is for us to go out there and make the discovery. All of this points towards an excellent buying opportunity with a share price that's not included any of the de-risking from 2021. And with the start of the exciting phase 2 campaign, with near-term catalysts drilling throughout 2022 and advancing a project towards a discovery. So I'll give a little bit of background for people who aren't familiar with helium. It's available for a broad range of high-value end usage, things which it can't be substituted, and which is difficult to recycle. It's got a number of key growth sectors, mostly in high-tech industries, healthcare, and computing, cloud storage, fiber optic cables, that sort of thing. Because of this, we're expecting quite dramatic growth over the next 10 years, from 6 billion cubic feet to 8.5 to 10 billion cubic feet by 2030. And existing suppliers can't keep up with demand. It's structurally undersupplied. We saw that over the summer when, with a few small plant outages in the United States, there were dramatic shortages, and people had to cut back on their production of semiconducting chips. New primary helium projects are required to meet the demand growth, and that is especially true as we transition from the carbon economy to a green economy, because all these existing supplies was a byproduct of hydrocarbon production, and Helium-1 has the green differentiator. We have our helium sourced as a byproduct with nitrogen. It's a high-grade primary helium source, 10.6% measured at surface with a 90% nitrogen carrier gas. That means that we can produce carbon neutral helium. With COP26 less than 2 weeks away, and as we transition from a carbon world to a green world, this is going to make Helium-1, which is already a strategically important asset, into an essential asset, as we don't want to turn off the internet as we transition to a carbon economy. Helium-1 is very significant for this transition. So what is Helium-1? The company was founded in 2015, where we secured 100% ownership over 4,500 square kilometers of licenses. We've got three project areas in Rukwa, Nyasi, and Balangida, all of which have got unique geology and large potential for helium. We have a wealth of historic data, which allowed us to calculate an unrisked prospective recoverable helium resource of 138 billion cubic feet. That's the largest helium resource in the world. It's sufficient to provide the entirety of world demand for over 20 years, or more realistic 10 to 15% of global demand for over a century. So we're talking about something globally strategic. We're talking about something very high grade, up to 10.5% measured at surface. That's between 50 and 200 times higher than anything currently in production. And all with very simple logistics out to the port of Dar es Salaam and out to market. We've been engaging in phase 1 exploration throughout 2021. This started in February with our 2D seismic campaign that ran throughout April, and throughout May and June we were able to process the results of that. We built up on our historic seismic database and added a wealth of new prospects, including Tai, which was a must-drill prospect based on a very nice looking 3-way dip closure. That's where we placed our first hole, which was commenced in mid-June. It was a very good prospect, and we've done very cost-effective phase 1 exploration. Our faith in drilling Tai was rewarded less than a week into drilling, when we had our first helium show in the lakebed formation. We can continue down, finding helium again in the red sandstone formation, which is where the rods parted, and that was actually the start of our troubles. By the end of July, we drilled into the Karoo. We'd seen thick seals. We'd seen good quality reservoirs. We had 5 stacked helium shows. That's helium coming up with the drill muds as we advanced the rods. But we weren't able to test them because of downhole problems. So what went wrong? We had anticipated, based on historical drill data, that we would have a well-consolidated medium porosity reservoir. Now, slim well drilling would have worked in a well-consolidated rock. It's a tight formation. The extra pressure caused by the mud around the bit doesn't cause excessive damage, and you have a very cost-effective exploration tool. What we found, against all expectations, was that we had a good to excellent quality reservoir. Now, this reservoir was unduly affected by slimline drilling because it was unconsolidated. The result was that the high pressure that you get across the face with slimline drilling caused excessive formation damage. It pushed mud into the reservoir. It created washouts, all of which prevented us from running our wireline tools down, and masked the pay zones which we were hoping to identify, and which we had hoped to see beneath an excellent quality seal. Basically, because of better than expected reservoir, we had to pull the plug on our slimline exploration campaign. Well, what that all points to is that we need to come back with a conventional drill rig. So with conventional drilling has much lower pressure across the bit, because you have a wide bit on a narrow rod, which gives you a nice wide annulus. You don't get the buildup of pressure across the bit, and we could drill these unconsolidated reservoirs with that bit. We need to mobilize a different rig to achieve that. So what did we learn out of 2021? Well, we have proof of concept, and that's significantly de-risked the basin. What I mean by proof of concept is that for the first time ever, we've proven charge and migration in the subsurface. We've proven that we have this excellent quality reservoir all the way down through the Karoo. And we've secured rock cuttings for further analysis. We can really properly understand the stratigraphy of the basin, which will help us to plan our future drilling campaigns. Seal was the biggest risk before we started drilling. That's because of a lack of clay in the basin. It's a very sand-rich basin, but also helium is a very elusive gas. What we identified is a very good quality seal, 130 meters thick at the top of the Karoo. But we also found thinner but effective seals at multiple levels above that. All of that has showing that we've got a stacked system with helium shows at multiple levels, running from near surface all the way down to basement. And putting this together, we have, for the first time, proof of a working helium system. That's shown from the mud shows and from the logging that we've got. We do 2.2% helium in the lake bed formation at only 70 meters. That's a very positive indication. We had 1,000 times background level in the red sandstone that wasn't able to be tested because the rods parted in the midst of drilling this helium show. In the Karoo, we've had good quality seal, excellent quality reservoir, stacked helium mud shows. We weren't able to test it because of formation damage. All very challenging, but all very positive. What we have is a basin where we've got helium in places that we never really expected to see helium. Who's ever heard of a helium show as 70 meters beneath a standard heliclastic play? Who's ever heard of 5 stacked sequences within a 5 stacked mud shows within a single formation in the Karoo? All of this points towards a basin with a lot more helium than we had anticipated, and with several new play types and several untested play types, which we need to investigate as part of our phase 2 drilling. So what is phase 2? Phase 2, we've loosely divided these plays into shallow targets and deep targets. Now, deep targets are primarily focused on the Karoo structural play. That is helium trapped beneath the top seal, the 130 meter thick sealing claystone that we identified in drilling Taiwan, looking for similar structures, or indeed drilling the same structure across the basin. Now, to drill deep targets, we're going to need a conventional drilling rig. And we can't mobilize one of those in the wet season, but there's no off switch at Helium 1. So what we're doing is we're pushing on with 2D seismic that's mobilizing before the rainy season comes. And that's going to focus on the northern extensions of known helium bearing structures, which we've seen at Tai and in Itumbula. We know that these structures work as a focus for the migration of helium in the subsurface. And so we're expanding our seismic campaign, which in 2021 was limited to just the basin edge, because we only wanted to drill down to 1,200 meters depth with our slimline well. We're now going deeper into the basin so that we can have a slew of targets to complement our Tai target when we mobilize our conventional rig in 2022. Within the top 400 meters are what I refer to as shallow targets. Now, these are based on the intraformational lake bed play, which we identified with drilling of Tai 1 and investigated further with the drilling of Tai 2. And what Tai 2 showed is that the intraformational play, the reservoir with the strong helium show, which we identified as 70 meters in Tai 1, was sealed by conventional heliclastic clay. Now, we've got a basin with a lot of clay in it. If it was done by some unusual salt or volcanic tuff, I might have been concerned, but with a lot of clay, there's a lot of potential for this type of play and this type of trap to be repeated across the basin, and for us to find multiple occurrences of shallow helium. Now, you must remember that helium is worth over 100 times more than natural gas. So whereas a conventional oil and gas exploration team would not go looking for plays in the top 400 meters, for a helium company, this offers a low-cost exploration and a low-cost route into production and eventual development. So we're trying to use geophysical techniques to give us direct gas indicators. And we're focusing on electroresistance tomography and magnetotellurics, but both of which analyze the resistivity of the ground to identify void spaces. Now, ERT grew out of civil engineering. If you're going to build a skyscraper, you don't want to do it above a big cave. So it's to recognize void spaces in the subsurface. I'll point your attention towards the section at the bottom there. Now, ignore the big purple caves, they stand out quite obviously. But you can see the orange horizon marked limestone. Now that is a limestone horizon where the void spaces are filled with gas. And as you go right into the fracture zone, you can see that this orange horizon becomes green because the void spaces in the fracture zone are filled with water. So with tie 1, which had strong gas indicators in a shallow trap, and tie 2, which were trapped wherever you would a closure, so you didn't have the reservoir in place. We've got the perfect test bed to calibrate our ERT survey, so that we're able to use the responses there to identify void spaces filled with gas, and potentially, hopefully, develop a portfolio of quite shallow targets to be tested with a lightweight drill. A lightweight drill we can mobilize in the wet season, so we'd be looking to get that in Q1 and Q2 of 2022. In the event of a discovery, we have got a very low capex development. We've done a top-level scoping study based on theoretical gas composition from what we're measuring at the surface to produce 350,000 MCF a year, which is about 1 truck a day. Each truck contains about $250,000 worth of gas. And the capital cost of that would be about $50 million. With the production wells and wellhead gathering system, you'd be looking at maybe $80 million. Now, this is a modular plant, so you can add a phase 2 train or a phase 3 train. You can also adapt your train for whatever shows we find. So if we find a shallow show, a shallow play, which turns into a shallow discovery, then we could potentially use a scaled down version of the same modular plant to enter production for quite a low cost. This is all to be investigated throughout 2022. And in production, the logistics to port are very simple. We've got 130 kilometers of unmade road between our site and the Tanzam Highway. That needs to be run over with a grader to smooth out the bumps. The Tanzam Highway, I've spent a lot of time driving up and down that damn road, and it's very good quality, tarmacked all the way from Rukwa to the port in Dar es Salaam. And you can see from the map at the bottom there, the shipping routes out of Port of Dar es Salaam naturally lead us towards the markets in the Far East and Europe, where there is increasing growing demand for helium for high-tech manufacturing, especially semiconductor chips and fiber optic cables being produced in China, Japan, Taiwan, etc. In fact, they're just building a new helium storage facility in Thailand because there is such demand and such instability of supply out to the Far East. That's really where I see us being able to market the majority of our material, and for a good price. So that's us. It's a transformational opportunity. It's time to change the helium market and to focus on a supply which can be part of a green transition. The green economy is coming. Just because we have switched off our petrol cars doesn't mean we're going to be prepared to switch off our cloud data centers, and we need helium as part of this future society. It feeds into the digital revolution. And in Rukwa, because of the size of the project, the high grade, the high BCF in the undiscovered resource, it's got potential to be a globally strategic resource which can feed in over a century worth of supply. This resource has been significantly de-risked. And I'm looking forward to being able to advance our development and our exploration throughout 2022 as we bring this project towards discovery. Thank you.
Okay, David, that was brilliant. Thank you so much indeed for all that. Let me pick you up on with my first question. You may believe you've de-risked the Rukwa Basin, but some might say that you've only begun to de-risk the basin, given that you haven't actually made your first commercial finds of helium. So what's your response to that, David?
Exploration is an application of science to data, and it's an iterative process. We went out with great expectations, and I really thought we had something with our phase one drilling. All the right indicators were there. However, with the rig that we bought, we weren't able to close the deal. We weren't able to flow any gas to surface. We're able to take everything that we've learned from phase one and apply that into phase two to make sure that we've got the right equipment, the right bit, the right people behind the project to make sure that everything works, and we're actually able to make a discovery this year.
Okay, Paul Jones follows up on that and says, would you drill it again? If you're so sure that you've got so many things right about Taiwan, would you simply just drill more or less in the same place, the same area, and do it right this time and learn so much more, maybe make a commercial find of helium?
Yeah, I mean, Tai is a fantastic prospect, and the way that we drilled it limited our ability to make a discovery. With excellent quality reservoir like that, you can't apply that sort of pressure across the bit. We didn't know we had that type of reservoir. We thought that I suppose it's basically the same as if you're drilling a high-grade gold, you'd need to bring a different drill machine, which isn't something that I, as a mineral geologist, is used to. However,
but would you do it again?
Yes.
You know, with the appropriate kit this time?
Yes, absolutely. And I believe that with a conventional rig, I think we've got every opportunity of making an exploration success here at Taiwan, and everything's pointing towards it.
Let's take phase two. So what does phase two look like? You've got £10 million of funding. How far does that go? Who will you be drilling with, and where are you in terms of contracting the next drill and so on?
Okay, so we're I mean, the problem with conventional rigs is that the lead time on a rig of that size is normally 6 to 9 months. We're talking with a range of suppliers. We're trying to find something that's got the right combination of cost and availability for us to deliver an effective exploration program in 2022. Bear with us a rather fluffy timeline at the moment. As we contract and develop, we can start to narrow down. And
so that's work in progress, is it, David?
Oh yes, yeah, very much work in progress. And that's really what 2022 is for me. We're not going to pause. We're not going to stop because it's raining. We're going to run our geophysics so that we can advance our portfolio and introduce new drilling targets to complement existing drilling targets, so we can investigate the numerous plays that we have. But 2022 is, for me, really a year about discovery. It's about applying everything that we've learned in 2021 and in the previous 5 years, and making sure that we get it right and we make our discovery.
Okay, Nahid Hussain and Ashley Hibbert both ask the same question. How far does £10 million go? How many drills do you get for £10 million?
It goes a long way when you're tight-fisted as I am. We're financed to do all of this geophysics. We're financed to do the drilling. Would we raise more money so we have a buffer, or so that we can mobilize for more drilling if we have more targets? Yeah, sure. But are our backs against the wall? Absolutely not. We're a well-financed company, and we've got a lot of exploration mileage ahead of us. Okay,
Kevin Bradle asks a reasonable question. What kind of relationship do you have with the Tanzanian government, and are they happy with progress so far?
We've got very good relationships with the Tanzanian government. They've always been very supportive of our project. We maintain regular communications through the ministries. We welcomed the Minister of Mines out to our camp while we were drilling. It's all a very collegiate atmosphere out in Tanzania, and yeah, I highly recommend it as a jurisdiction.
They're used to gas in Tanzania, but probably a lot less used to helium. Is that fair?
It's this is the first primary helium exploration project in all of Africa, and yeah, it's new for everyone, and that's what makes it exciting.
Okay. Drew McGregor makes a very good point, which you touched on when you talked about shallow traps rather than deep ones. He doesn't actually think that the use of electroresistance tomography, which you were promoting there in your introduction there, and magenta telluric surveys, he thinks that identifying gas trapped in that near surface is not the way to go, because no ONG exploration company does this. They don't use that technology, and he thinks it doesn't work. So he does think it takes investor expectations the wrong direction, though. What's your response, your considered response to that?
Well, I mean, you've got to think that we're not exploring for oil and gas. We're a helium exploration company, and helium is worth 100 times more than the value of oil and gas. So you need to take off your oil and gas hat and think with a helium hat on. Now, if I was looking for standard Brent, I wouldn't be looking in the top 400 meters. You know, you don't have the pore pressure, you don't have the volumes trapped within the same size closure. But for a helium gas, it's worth 100 times more. You can potentially find an economic accumulation within the top 400 meters. I think if I did some calculations, and if your reservoir was at 250 meters, you need a closure of about 7 square kilometers to contain a BCF. A BCF of gas is worth between $250 and $350 million, which if your cost to bring into production is only 30 million, that gives you an IRR of over 55%. It's not the grand prize in the same way as the deep targets are, where you could get that same volume in a much smaller size trap. However, it has the potential to be economic in its own right. It has the potential to be a low-cost route into production, and it needs to be investigated. ERT is a very low-cost exploration method.
And the reason that the oilies don't use it is simply the economics are totally different.
Yeah, it's a totally different game. I mean, you know, nobody mines iron ore at 3 grams per ton, but you would gold.
Indeed. Okay, let's move on. Carl Patch wants to know what the current relationship with Mitchell Drilling is. There was a few other questions around Mitchell Drilling. Lay all these things to rest for us, will you please, David?
So yeah, Mitchell Drilling, that we've fulfilled they fulfilled their contract, and we've released the rig. It became apparent that slimline well wasn't going to work in the reservoirs that we had, and so continuing to drill with them would cause more harm than good. That was well understood. That the whole ran considerably over in time with the number of operational difficulties that we had. However, these contracts are paid per meter, so although the time overrun was high, the cost overrun wasn't. So look, I'm very happy with Mitchell Drilling. It didn't work out, but we're both fine now, and I wish them well in the future.
Okay, David Crowley asks what will be the final question. You've got one more minute to go. David Crowley says, David, with the plans you put forward today, via an RNS, how long will it be before we need to raise more funds, and by what amount, assuming we're still searching for that discovery? Well, I presume you are still searching by all accounts, so David, don't be like that. And tell us all, David.
Yeah, so we are in the process of identifying and contracting the correct conventional rig. In the RNS and in the presentation, I say that's planning to be on the field Q3 or Q4 of next year. That's a sort of a worst case scenario. Normally these rigs have got a 6 to 9 month lead time. So I mean, I'm hoping ideally to get stuff on the ground June, July, August, the same as we had this year, drilling the sweet spot of the summer season. As I said, we're well financed to do the exploration that we're doing at the moment. We've got £10 million left in the bank. Our backs aren't against the wall for raising capital. It's a very exciting year for 2022, and I think it's going to be really good to go out again with the right knowledge, the right equipment, and make this discovery that we've been promising the market. David
Minchin, CEO at Helium One Global. Thank you so much for joining us tonight and explaining in such detail what's going on inside your business, giving us an operational update. Unfortunately, we don't have time to answer all those questions. We have lots and lots of Helium One questions. Got through tons, haven't got through them all, so many apologies to you. Okay, David, thank you so much indeed, and we shall say good night to you.
Thank you very much, Shaun. Cheers.
And as we say good night to David, we say good evening to George Bennett.
Good evening.
So, greetings, George. Lovely to have you with us tonight.
Thank you. It's a pleasure to be on your show again.
And I'm just going to give you a resounding 25-second introduction, George. So you just hold on 1 second, and I'll be right with you. Our final company this evening, our South Africa-based rare earths company, Rainbow Rare Earths, or RBW. Rare earth metals are an essential component for permanent magnets used to construct motors and wind turbines, and most rare earths are found in China. Rainbow have two main low-cost, high-quality projects, the Phalaborwa gypsum stacks in South Africa and a trial mine at Gakara in Burundi. Rainbow have just raised 6.4 million in a placing. And here's CEO George Bennett. He's coming live from South Africa tonight to summarize the most recent deals and activities for us. All right, over to you, George.
Thank you, Donald. Good evening, audience, and thank you for taking the time out this evening. Just to go through my presentation, there's the disclaimer for all of us to take note of. And then, as Donald has mentioned, that rare earths are critical to the green revolution that's taking place around the world at the moment. And by that, what I mean is that we all know that there's government legislation driving electric vehicles in Western Europe and in the UK, and we also see worldwide emission control standards being adhered to or going to be adhered to with everyone signing the various protocols around the world. And there's massive push for green energy in the form of solar and wind turbines to try and get the world, and I'm sure Germany is close behind. Plus we have all the wind turbine projects that have been spoken about, be it in China, be it in the South China Seas, Germany, the North Sea wind turbine project, and so forth. And all these projects and these new targets for various governments require rare earths. And the key rare earths for the green revolution are what they call permanent magnets. And permanent magnets go into every new electric vehicle and your standard vehicle at the moment in terms of your electric windows, your windscreen wipers, and so forth. But very importantly, in the electric vehicles, the drivetrain or the drive motor for your electric vehicle requires between 1 and 2 kilograms of rare earth permanent magnets per vehicle, and each wind turbine, 3 megawatt wind turbine, requires about 2 tons of rare earth elements in their permanent magnets. So just to move on, as you can see, the 2 key elements for permanent magnets are known as neodymium and praseodymium, which are 2 of the 17 rare earth elements that we find in rare earth deposits. There's a total of 17 rare earth elements in rare earth deposits, and each deposit has various makeups of these different rare earth elements. As I said, the 2 key rare earth elements are neodymium and praseodymium, and there's also another element called dysprosium, which is also quite important in certain permanent magnets. Now, permanent magnets only make up 35% of rare earth volume, rare earths by volume, but very importantly, 91% by value. And that you'll see is very important for Rainbow Rare Earths 2 projects, where we have high values of neodymium and praseodymium in both of our projects. And that translates into very high value for both those projects. If we just quickly move on to global demand for neodymium and praseodymium, as you can see, global demand from 2020 is set to increase dramatically by 2030, and that's, as I said, it's been driven by legislation and emission targets that the whole world is setting itself. And as I said, this is a structural change in global economies, and it's not going away anytime soon. So if anything, it's going to accelerate, and that forecast is probably conservative. We go on to our next slide. Once again, this is just showing you projected annual global electric vehicle sales, which, as you can see, are increasing quite dramatically. And as I said, this is not going away anytime soon. And then, of course, we have permanent magnets, which are required in wind turbines. And as I mentioned, 600 odd kilograms per megawatt. So 3 megawatt wind turbine takes up to 2 odd tons of rare earths in the permanent magnets. So that's a huge amount. And if you research the amount of gigawatts being forecast to be rolled out over the next 10 to 20 years, you'll see this translates into a massive demand for neodymium and praseodymium. If we move on to where we see the demand balance, the forecasters for once got it right in 2020, towards the end of 2020. They forecast that we'd be going into deficit, and we saw this happening in the neodymium praseodymium market, and where we saw prices of neodymium and praseodymium spike starting in the last quarter of 2020 and continuing into 2021. So as I said, so far the forecasters have got this right for a change. Slide 8 is quite important, where it shows Rainbow's 2 projects in terms of their rare earth baskets. As I mentioned earlier, all rare earth deposits have a combination of 17 rare earth elements in what's known as their rare earth basket. And both the rare earth baskets, we have the Paterson project in South Africa and the Gokara project in Burundi. We have high percentages of neodymium, praseodymium as a value of our rare earth basket. And you can see the price forecast for our basket that out to 2030 in the dotted line. But the actual price of our basket has outstripped the forecast quite considerably. As I mentioned, towards the last quarter of 2020, we saw the rare earth prices for neodymium and praseodymium rise quite sharply, and they've continued to maintain onto those rises. And the forecast for 2022 is that there's going to be continued price appreciation of these 2 key rare earth elements, as well as dysprosium and terbium, which are quite important rare earth elements. Now, if I can move on to our key project, which is the Paterson project. This is a project in South Africa that comprises of plus minus 38 million tons of gypsum residue. And the gypsum residue grades at 0.43% total rare earth oxides. Now, this might sound quite low, but when you compare this rare earth resource to ionic clay deposits in China and elsewhere in the world, you'll see that that grade is significantly quite high, between 0.42 and 0.46% TREO. As I mentioned, these gypsum stacks are situated in Paterson because for a period of 50 odd years, next door, we had a phosphate hard rock deposit being mined for phosphate. The phosphate hard rock was converted through a flotation process into a hard rock slurry, and then piped next door to a phosphoric acid plant, which was run by Cathal, the chemical conglomerate in South Africa. This phosphate slurry was the feed for, as I mentioned, this phosphoric acid plant. And the phosphoric acid plant went through 3 stages of phosphoric acid production. And in each of these stages, a gypsum residue was created. Now, the rare earth elements were present in the hard rock deposit at Phoscore, but not in economic quantities. And with the formation of a phosphate concentrate, this was through a flotation process. Your rare earth elements were upgraded in the phosphate slurry, and then, as I mentioned, transported next door to the phosphoric acid production plant. And in the 3 stages of phosphoric acid production, the gypsum residue that was eventually sent out to the waste stacks after the third stage. At each of these stages, the rare earths were further upgraded in the gypsum residue that they now are present in economic quantities. Very importantly, we've got very low uranium and thorium, one of the lowest of any project in the world, and that makes this a very green project and has huge ESG credentials. Another thing to remember is that these two gypsum stacks that we have at Phalaborwa, as I mentioned, totaling 38 million tons, they have an environmental management system in place, and we will be cleaning up these gypsum stacks and redepositing a clean, benign gypsum on a new gypsum stack to RFC standards, which makes this project a very big ESG cleanup project and very green. If I can move on to this next slide, this demonstrates why we believe that this will be a very low capital intense project, because the gypsum that sits on the chemical stacks is basically in a cracked chemical form. Now, if you research any rare earth project, you'll see that they have to mine, crush, mill, produce a rare earth concentrate, then they have to crack their rare earth mineral into a chemical form before they can do downstream processing. Sasol were able to go straight in their pilot plant that they built some 7 odd years ago. They're able to go straight downstream and produce a mixed rare earth carbonate because the gypsum sits in a cracked chemical form. So all your costs associated with hard rock mining for a normal project, run-of-mine stockpiles, crushing and milling, flotation using reagents to produce a concentrate, and then gang leaching this concentrate, and then you have to crack your rare earth mineral concentrate before you can go into rare earth leaching, which is where Phalaborwa comes in. So we've got very, very low mining costs because it sits all above the ground as a resource already. It's not mined. This was produced through a chemical process, but it sits on these two gypsum stacks. And as I mentioned, we will have a very, very low reprocessing cost of sort of below $1 a ton, whereas a hard rock mining open pit project, your mining and hauling cost, just to give an example, is anywhere between $40 and $60 a ton. So we have a very, very low cost there, and we don't have to go through as many stages as other rare earth projects. And so as a consequence, we believe that this will be a very low capital intensity, a very low OPEX project, just simply for the reasons I've outlined ahead on this slide. We now move to the next slide. You can see also did a deal with K-Tech. Now K-Tech is a technology in Florida that we have signed an exclusive right to for phosphate gypsum in Southern Africa. And basically what K-Tech does is that allows us to go even further downstream at Rainbow. So we can go into separated rare earth oxides. Linus claim that they will be the only scale producer of separated rare earth oxides outside of China. Well, Rainbow will be the second scale project, because we're going to go all the way downstream by using this K-Tech technology. It allows us to, with a lot lower capex and opex, to go into separated rare earth oxides. And and we get there in between 6 and 9 steps. Whereas using traditional solvent extraction techniques, we literally have to have hundreds of steps to get to the same rate of separation that we're going for at Rainbow. And very importantly, we only chase 4 rare earth oxides, separated oxides: neodymium, praseodymium, dysprosium, and terbium. Those 4 rare earth oxides will give us 95% of the value of our basket. So we're very fortunate in that. And we'll get there between 6 and 9 steps, as opposed to literally hundreds of steps with a traditional SX plant. This project has been piloted on rare earth phosphogypsum for rare earths in Florida. And in North Africa, it's been piloted on a large bulk scale on phosphogypsum to remove uranium and thorium, and we know it's been successful in North Africa. So we believe this project is largely, this technology is largely proven, and before we finally incorporate this into our project at Phalaborwa, we'll also pilot test it on site at Phalaborwa, where we have a pilot plant as part of our JV agreement with Bosveld. So we believe this project is largely, this technology is largely de-risked. And very importantly, KTech have applied it commercially in a number of other industries like the lysine, sugar, phosphate industry to date. So we believe it has been largely de-risked. Just to move on to where our footprint, our projects against other projects around the world, just a few projects. There, our footprint is Paterson against other rare earth projects of iron and clay in nature. And you can see we literally between 6 and 10 times higher grade, which is very important. And very importantly, you can see our neodymium, praseodymium content parts per million is off the charts compared to those other iron and clay deposits. And our uranium and thorium levels are very, very low. In terms of Rainbow's hard rock project at Cathal in Burundi, once again, a very high grade deposit, very, very high, as I mentioned, the neodymium and praseodymium, as you can see from that table, and very importantly, low levels of uranium and thorium compared to some other hard rock projects in the world right now. If you look at Linus's thorium content, you see it's significantly higher than Rainbow. And we all know that Linus has had problems with the Malaysian government where they've had to build a whole new separation facility in Australia because the Malaysians will not allow Linus to ship their concentrate to Malaysia anymore for downstream processing. They want their radioactive waste to be kept in Australia, where it came from in the first place. If we look at the actual gypsum stacks at Paterson, very importantly, this project sits in the middle of a mining town. There are three operating mines right on the border of Paterson. So we have all the infrastructure available to us on our doorstep, which is an airport, 2 rail sidings, which operate on this site. And on the right-hand side of this photograph, there's a phosphoric acid plant that's been mothballed. I forgot to mention for the last seven years. It ceased to be operating, but what's intact on the site is all the administration offices, all the workshops, the machine shops, the vehicle storage shops and vehicle workshops, laboratories, and 2 rail sidings, as well as a high voltage switchyard, high power voltage switchyard at the base of the one stack, and all that infrastructure is in place. And this infrastructure on a normal project would represent about 20% of your capital costs. So this is another big saving for the project we have at Paterson, very important. Just quickly to go through, you can see some of the photographs of the infrastructure, as well as the Cathal pilot plant built and operated some 7 years ago. This plant produced 3 tons of a mixed rare earth carbonate, so it was a pilot plant at scale, and we know it successfully extracted rare earths out of the P-phosphate gypsum. There's another photograph of the pilot plant, and here's the details of our earning agreements that we have at Paterson. So it was a very good deal that we did last year, and we expected to produce a very, very good project in terms of low capital costs, low OPEX, and we're expecting this thing to generate somewhere between $220 and $250 million of revenue. And we have a very fast track timeline for the project. We're busy doing a PEA, which will be anticipated to be complete by the end of this year. And the next year we'll go, in all probability, straight to a bankable feasibility study and to go into project funding at the end of next year to start construction somewhere towards the end of the first quarter or the beginning of the second quarter of 2022. It's a very fast track project for essentially, which is a new project we only acquired in November last year. Just to quickly finish off on Gokara, a very, very high-grade hard rock project in Burundi. We have 57 targets, all of them mineralized, which is key, and we have 7 historical Belgium rare earth mines within our mine license area, very importantly, and these are just after the exploration work we did last year. These are our current exploration targets that we will look to use from cash flow generated from the project within Burundi. As you can see, before I got involved in Rainbow, we were mining on the left-hand side of the screen using literally, this is where the Belgians mined it. I called it artisanal mining on steroids. We had a bit of yellow equipment to remove dirt, and then we hand mined the very high-grade rare earth veins. We changed the mining methodology last year into more conventional open pit mining, increased the fleet to a more conventional style mining fleet, open pit mining fleet. And I'm pleased to say that We achieved cash flow positive territory in June this year and at the end of June, the Burundi government put us on hold for production in Burundi while we renegotiate the mining convention. Now, we've seen in various African countries, governments look to renegotiate the mining conventions, but something we have to live with. We are due back in Burundi next month to negotiate with the governments the terms of the changes to the convention, and we expect that there will be a win-win outcome for both Rainbow and the governments. That's it in a nutshell.
Okay, that's absolutely fantastic, George. Given that we're on that last slide, Mike, why don't you just keep slide number 20 up for me, please? Yeah. So what's going on with the Burundi government, and just shine a little bit of a light into that, and how quickly you think it's going to be resolved, George. What's a positive outcome for you?
As I said, we've received a letter from the Minister of Mines indicating that we will get dates set for negotiations towards the end of November. So towards the end of November, I expect to be back in Burundi in negotiations with the government to get us back to mining, back to exporting, and finalizing the terms of a new convention towards the end of the first quarter of next year. And during that first quarter, I would also expect mining operations in Burundi to continue. I might stress that we have $1.4 million of concentrate ready to be exported, which all the costs associated with that concentrate have been incurred by Rainbow already. So that will kickstart the re-establishment of the mining operation in Burundi without any drain on the corporate G&A from the funds that we've just received from our capital raise that we closed last week in Rainbow.
So Dave Harris is asking, has an export agreement been reached with the Burundi government? But is that the issue? Is it a renegotiating of the mining conventions rather than export?
It's a renegotiation of the mining convention, which will allow us to resume exports and resume mining again.
Great.
But
okay.
I might just stress that Burundi, in terms of Rainbow, is far smaller than what it was prior to the Palabora project coming on. Just to give you an idea, the Palabora project, we expect to generate revenue, as I said, north of $200 to $250 million per annum. And the Burundi project at full-scale commercial production at current pricing will only produce revenue of about $30 million a year. So there's a significant difference in the size of the projects.
No, it's absolutely true that Rainbow Rare Earths has actually transformed. In the time that I've been doing interviews with you, the business has actually transformed. The different deals, the way you've knitted these different elements together is I have to say, is pretty impressive, George.
Thank you.
Let's talk Phalaborwa gypsum stacks. Bosveld. Now, without Bosveld, you actually wouldn't be able to do all this because Bosveld actually owned the site and owned the stacks.
Correct.
So talk us through the 70-30 joint venture that you've struck with them, which is one of these great deals that you've done.
Yeah, so we were fortunate enough to seize on this opportunity and have a relationship with the owners of Bosveld, and basically agree on a deal where they put in the resource and the infrastructure, which is significant, as I mentioned, and for that, Rainbow will fund the establishment of the rare earth processing facility, and for that we get 70% and they will get 30%.
And then the next element you've added on top of that is K-Tech technology, which separates the NdPr from the gypsum, which in itself is a transformational for Phalaborwa.
Yes, well, the beauty of that deal is that if we stop to the mixed rare earth carbonate, which a lot of rare earth projects in the world do stop at, we would only achieve about between 65 and 70% of the separated rare earth oxide price. The fact that we now go all the way downstream to produce separated rare earth oxides means we'll get close to 100% of that separated rare earth oxide. So we get a kicker of plus minus 30% in our revenue. And I can tell you that we don't have the numbers yet. It'll come out of the PEA. But the capital that we incurred to go all the way to a separated rare earth oxide will be very, very quickly paid off by the increase in the revenue that we get.
And how sure are you that the K-Tech technology will actually work?
As I said, we are at this stage about 95% sure. We can only say 100% once we've piloted it ourselves at Palabora, but it's been piloted on phosphogypsum for rare earths in America. It's been piloted on phosphogypsum in North Africa or at a large scale for uranium and thorium extraction from phosphogypsum, which is essentially the same process that we will be doing at Phalaborwa, and it's been applied commercially to other industries. So it has been largely de-risked. It's just that final tick in the box can only come with our hand on our heart once we piloted ourselves at Phalaborwa.
Fair point. Martin Curry asks, is there a possibility you might be able to use the K technology in other phosphogypsum projects in Southern Africa? Have you come across any which might be suitable, George?
It is certainly applicable to other phosphogypsum projects that we might come across in Southern Africa, and we are investigating other opportunities.
Do such things exist, though? I mean, is this simply one-off, or are there actually other gypsum stacks out there, or is it simply not yet known?
Can I plead the fifth?
Yeah,
no,
commercially sensitive is the phrase I think we use.
Yes, yeah, it's commercially sensitive.
It's commercially sensitive, not a problem. I'm moving on. People have been asking what the 6.4 million placing money gets spent on. It was a good raise. What's that for? Is it possible to break down where that money goes for us? CapEx and the various lines in the budget.
So, part of that is to complete the PEA that we've started at Phalaborwa. It's been kicked off already, which is significant, obviously, in terms of footprinting the profitability of this project and the IRR of this project for the whole world to see. And that's also going to enable me to complete a bankable feasibility study on Phalaborwa. So it's quite significant in the fact that I don't anticipate coming to the market again for funds to complete a bankable study, which will obviously, hopefully, if my knowledge of the project is correct, which will obviously showcase a fantastic project at PEA stage as well as bankable stage. But very importantly, we will be funded through to that stage of the project.
In this latest raise, you mentioned an interesting company called TechMet who participated in the placing. Is it possible to tell us who TechMet are and why that relationship is significant? Why it's a real feather in your cap? Well,
TechMet came in as a cornerstone investor in this raise. They were already a tiny shareholder in Rainbow, but they've now, after 2 years assessing various rare earth projects around the world, they've decided to make Rainbow their preferred rare earth player. TechMet is a strategic minerals fund, which is largely funded by the US government. So the DFC, I think, invested circa $150 million into TechMet last year, and which is, as I said, significant because it's essentially the US government, and the fact that they now are taking and building a strategic stake in Rainbow, I think, is very significant.
Okay, two final questions. I am very cheeky, George. Ian Wright asks, what are the projects that are in the pipeline? Peter Woolston-Holmes asks, what's happening in Zimbabwe? So are there any other projects in the pipeline in Zimbabwe? I can conflate those two questions. What do you make of all that?
So Zimbabwe, we have licenses on prospective rare earth ground that we've pegged. We are just starting a very, very small initial exploration program there, but it'll be a hard rock rare earth project, if it is a project at all. As I said, we need to do the exploration, but it has been identified by the USGS, which is the United States Geological Society, as having the potential to host rare earth. So we're in the right neighborhood, we know that. It's just a question of whether there's anything economic there. And then, and yes, we are looking at other opportunities. That's all I can say in the phosphogypsum arena.
More commercial sensitivities.
Yes.
Okay, George, you've been fantastic. Thank you so much. Last company tonight, and even in a very starry lineup, that was most definitely not the least. I just think terrific. What you're up to is just terrific, George. Thank you so much for sharing it all with us. That's it from us. After a huge evening, we've had a fantastic audience.
Thank you very much. And thank you to your audience for listening.
Yeah, it's our pleasure, George. So thank you very much to all our speakers for joining us live from around the world tonight, and to all their teams, particularly all their teams, because I know everybody works really hard behind the scenes to get them here. And not forgetting our team, we've got Dave Mutton, we've got Mike Bowden, and the London South East team, all behind the scenes here, who put in a lot of hard graft to deliver this great event for you tonight. Thank you also to our sponsors, Primary Bid, who have a constant flow of interesting IPOs for you on primarybid.com. Do think about registering there. And by the end of play tomorrow, we will have edited and released all 4 company presentations for you. So do watch out for those on YouTube, London Southeast YouTube. If you subscribe to that London Southeast YouTube channel, you will be the first to see those. And by the end of the week, we'll package together the company slide packs and videos, all in one useful email for you. So look out for that one as well. And of course, we've enjoyed it so much, we'll be doing it all over again on November the 16th with Ailey Metals and Advanced Energy. There's a date in the diary for you. A huge thanks to you all for being such a great audience and staying with us to the very end, not the bitter end, I hope. We're truly grateful for your time. Good night, and may all your investments be good ones.